which is really scary, is that in the last 5 years or 6 years, all the new debt, the giant consumption binge that we've had, which has been a lot of fun, all that debt and all that treasury debt that was created, 85% of that has been sold to foreigners. So it isn't true that 85% of our whole debt is overseas, but 85% of the top end of the balloon that's happened in the last 5 years is now held by people that you just mentioned, the Russians and the Chinese and so forth. I think it's amazing. The one thing, I would read this to you only because I think it's important, perhaps. Doug Noland is an amazing guy. He's a very, very bright guy. We've quoted him and used him over the years because his Credit Bubble Bulletin, which he writes weekly, probably got the best information to update you on what's going on in money and inflation and currencies and in commodities around the world. But in his latest letter, which points out what I'm saying, he's never said this before, but in his latest letter just this week, he says, a new inflationary epic. I want to read this quickly, and then we'll swing back to you. He says, crude oil closed today at $126, the most vitally important commodity in the world. We've said that in the McAlvany Intelligence Advisor many times over the last 5 years, that oil maybe was the true money of the world. The most important commodity in the world has now posted a stunning year-to-year rise of 30%, which is what you just said, and has now doubled over the past year. So it's up 30% this year, and if you go back 12 months, it's doubled. It is worth noting that during the 10-year period, 1996 through 2005, crude oil averaged $29 a barrel. It's 4 times that level today and running. Then he says, I don't believe it's a mere coincidence that the crude has posted a 30% year-to-year surge at the same time that international reserve positions have experienced a 30% annualized rate of gain. He's talking about international monetary reserves. So what's fascinating is that not only have we printed and created debt one upon another, tens and 1, 2, 3, 4 trillion upon another, but that all the other nations in the world, to stay in the game, have taken the money, they sell us goods, send them dollars, and instead of selling the dollars back into the market, which would then depress the dollar, and the dollar would collapse, and we could no longer buy anything, instead of doing that, all the foreign governments have devalued their own currencies by buying the dollars that they get from us with their own currency, and since they don't have any new currency of their own, they're printing currency to buy our worthless currency in order to keep the game going. That's where hyperinflation comes from, when everybody gets in the game together and nobody can stop. Does that make sense?
What you're basically saying is what would be unprecedented this go-round is that it's not limited to, say, the Weimar Republic. It's not limited to Argentina. It's not limited to a currency collapse in Thailand. Because we've become so interconnected on a global basis.
You think for a minute. They're all competitively devaluing their currency so they can keep their trade going. And every government in the world has one great fear. That's unemployment. If people are unemployed, you have civil war. So immediately, you'll do anything to keep the game going. And amazingly, it seems America has trapped the rest of the world into our hyperinflation cycle because they want to keep their people employed. That's what you're talking about, is just employment.
Does it seem like it's an extension, Jim, of being trapped in the consumption model versus the saving model?
Sure.
You know, if the whole world is being trapped into consuming and their savings goes away through inflation, then really what you have is just like what we've had. Our government now doesn't encourage more productivity. They encourage taking your $600 or your $1,200 and going and spending it quickly.
But I read another guy yesterday who had a great idea, and it really stuck with me, obviously, and I had kind of thought like you did up until yesterday. But what he was saying was, he said, we've consumed, and therefore we've gone in debt. We've exported. We used to export things. We used to produce things. We were the greatest producing country in the world not long ago. Now we export debt. That's all we do. We don't produce anything in this country of any size, not even for ourselves. So we export debt. That debt becomes savings, believe it or not, in foreign nations, in Russia. And you went through it. The currency reserves, China, Japan, Russia are number 1, 2, and 3 in currency reserves, and 2 of them are above $1 trillion in currency reserves. Now, think for a minute. They can compete. This goes back to where we started. They can compete with us in world markets to buy oil, to buy coal, to buy rice, to buy wheat, and they've got the savings, and we don't. If we have to buy those things from here on, the United States has to buy those with debt and hope somebody trusts us.
So you're really talking about a bidding war.
Oh, man. Yeah, and see, that leads you into hyperinflation. Does that make sense?
Yeah, but are we talking about a worldwide hyperinflation,
Sure.
Jim?
Yes,
I mean,
you are.
it sounds to me like if they're competitively devaluing, this could be affected on the euro, the Asian currencies, what have you.
That's right. That's the saddest part, and the only reason that people might want to think about hyperinflation is, in my opinion at least, it's very easy. If you go back to Germany, Germany got into a huge hyperinflation in 1921, 22, and 23. It happened simply because the war reparations, what people said they owed them because of World War I, were so huge that Germany could do nothing but print money. They could not work fast enough to pay off the debt the other countries had assigned to them after World War I. So they had a gigantic debt pyramid, and all they could do was print money, and it destroyed their country or destroyed their currency. In our case, we're looking at a consumption-led debt, but instead of just one nation in the center of Europe, we're talking about the U.S. dollar, the reserve currency of the world. We're talking about a currency where 65% of all nations, on average, world currency reserves are held in dollar-denominated assets. And where 85% of our, 65 is right, are held in U.S.-denominated assets. So what you just said, Kevin, would seem to make sense to some degree. How can they escape when more than half of their currency reserves are denominated in dollars?
Just a reminder, you're listening to the McAlvany Weekly Commentary. I'm Kevin Orrick, along with David McAlvany, and today we have Jim Deeds with us. Jim, very quickly, I'd like to ask you if you would comment on this article that you're currently writing. We got a chance to read an advance copy and want to offer to the listeners an advance copy just as soon as you feel it's ready to email. If they call us at 800-525-9556. But you make a great comment on page 4 that I think should actually just be a bumper sticker. It says, don't think of how many dollars something costs. Think of how many dollars you can buy with something real. Could you comment on that, Jim?
Right. To me, this is really fun because you're sitting there saying to yourself, instead of a group think, which we seem to be in America, it's scary how far we are. You're saying, how can I turn something upside down? So, I just started with what you do for a living. I started with the fact that if you look at a double eagle, a gold double eagle, $20 gold eagle in 1931, you could exchange that gold double eagle for one $20 bill. So a gold double eagle in 1931 would buy you one $20 bill. The same $20 gold double eagle today will buy you 50 $20 bills. So the fun of thinking is to say, what will something real buy in money terms? And I went on through that. They're simple when you look at it. 15 years ago, a barrel of oil would buy you probably, what would you say, $15 or $20, probably $20. Today, a barrel of oil will buy you 126 American dollars. If you look at a loaf of bread in 1932, a loaf of bread would buy you 7 cents. Think in reverse. A loaf of bread, if you wanted to buy something with it, would buy you 7 cents if you wanted to buy money with it. Today, a loaf of bread will buy you $2.50, $3, $3.50. A platinum coin just 10 years ago, a 10th-ounce platinum coin would buy you $35. A 10th-ounce platinum coin today will buy you about $220. Go to a watermelon. A watermelon, when I was a kid, you could buy a watermelon for 20 cents. They were 4 cents a pound. Today, I was just down at Whole Foods last week, and that's why I thought about it.